Have you ever felt confused and overwhelmed with all of the different types of retirement plans that are out there and thought to yourself, which is the right one for me? Then you'll like this two-part video where we will be reviewing the various types of qualified retirement plans, some that are a little bit more common and some that maybe you haven't heard of yet. Let's get to work. What's up, friend? I'm Kay Scholl. Welcome to another financial awareness video. If you're trying to make better financial decisions, grow your wealth and financial literacy, then you're in the right spot. In this first video, we'll be reviewing some of the more popular and well-known plans, such as the Roth IRA, traditional IRA, 401k, 403b, and 457 plans. But if you feel very comfortable about those and you want to skip ahead to the second video about these plans right here, then click this link right there. Okay, first up, Roth IRA. This is a qualified retirement account funded with after-tax dollars from your checking account. So no tax deduction for whatever you contribute into your Roth IRA. Although it will fluctuate in value over the years, it will likely receive capital gains and dividends. But as it grows, it will grow tax-free. And when you're ready to liquidate this account in your retirement years in your 60s, it will be liquidated and it will come out tax-free as well. Sounds awesome, I know. But because of how fantastic this account is, the IRS put income limits on who would be able to contribute to a Roth IRA. If you're single and make under $124,000 a year of modified adjusted gross income, then you're good to go. If you make between $124,000 and $139,000, then you won't be able to do the full amount, and over $139,000, sorry, you're phased out and can't fund a Roth IRA. For married filing jointly, it's $196,000 to $206,000 respectively. Don't be scared when you hear modified adjusted gross income. Your MAGI is defined as your household adjusted gross income plus any tax-exempt interest income and certain deductions added back in. Now, if you are flirting with any of those income thresholds I mentioned a moment ago, make sure that you double check with your CPA and your financial advisor so that you are financially aware of your specific situation. The amount you can contribute into your Roth IRA usually does increase each year and is currently capped at $6,000. Well, for most people, it's $6,000. You see, kids, sometimes in life you lose your hair, and sometimes you grow old. And sometimes you wake up one day like my buddy and you realize that you just turned 50. But don't worry, because now that you're 50, you can do what's called a catch-up contribution of an additional $1,000 per year, which is awesome. One of the downsides would be you're pretty much locking your money up until the age of 59 and a half. So as you throw money into this account during your working career, you need to make sure you have a long-term approach and the right expectations. If you have the ability of saving more money towards your future, it is a little bit of a bummer that they cap it at $6,000 per year. Now, if you fall within the parameters of being able to fund a Roth IRA, it is a fantastic account to grow and nurture during your working years while you can still fund the account. But people often ask me which one is better, the Roth IRA or traditional IRA? And the answer to that question is in the eye of the beholder. But you should be aware of two things. First and foremost, you can own the exact same mutual fund in both of these accounts. And number two, you're capped at $6,000 as I mentioned earlier, but that's $6,000 into either the Roth IRA or the traditional IRA or a combination of both. So you could put $2,000 in the Roth IRA and $4,000 into the traditional as an example. The pros and cons comparing the Roth IRA and the traditional IRA are more so based on the tax benefits of each of these accounts, your income, your financial plan, and most importantly, your exit strategy of liquidating these accounts during your retirement years. Side note, the backdoor Roth IRA strategy is going to require its own dedicated video, so keep an eye out for that. The traditional IRA is like the Roth IRA's brother. They're obviously related, but have quite different personalities. Unlike the Roth IRA, the traditional IRA is funded with pre-tax dollars. However, technically speaking, you can fund your traditional IRA from the same checking account where you would normally be funding a Roth IRA from. The difference comes when you file your tax return, because as long as you fall within the IRS income limits, then you can deduct your contributions into a traditional pre-tax IRA. No matter how much money you make, you can always contribute to your traditional IRA and the account will continue to grow tax deferred. However, if you make too much money, then you won't be able to deduct that contribution. So that's a bummer. If you are single and make under $65,000 a year of modified adjusted gross income, then you're good to go with deducting your contributions. If you make between $65,000 and $75,000, then you won't be able to deduct the full amount, and anything over $75,000 a year, sorry, you're completely phased out and can't deduct anything. For married filing jointly, those figures are $104,000 to $124,000 respectively. So if you fall within those income limitation guidelines, then you have the option of contributing to either of these accounts. So from a financial planning perspective, you just simply have to ask yourself, do you want to pay taxes on the seed or on the harvest? And here's what I mean. In this example, you'll notice that this account totals $677,000 after investing approximately $500 a month for nearly a 30-year stretch of time. And of that $677,000, you only contributed $205,000. So you just simply need to ask yourself the question, would you rather pay taxes on $205,000 and have $677,000 tax-free, or would you rather let $205,000 grow tax deferred and then pay taxes on $677,000 as you pull money out of the account each year during retirement? If you pull any money out of your traditional IRA before the age of 59 and a half, you run the risk of being assessed a 10% early withdrawal fee. However, currently going on right now, there is a very unique exception to this rule. Due to the CARES Act, if you liquidate money out of your traditional IRA between this window of time, then you will not be assessed that 10% early withdrawal fee. And there are some financial hardship exceptions as well, but generally speaking, as a rule of thumb, you do not want to liquidate money out of your traditional IRA before the age of 59 and a half. RMD stands for Required Minimum Distribution, and due to the Secure Act, you now have to start taking your RMDs by age 72. This is a huge strategic planning difference between Roth and traditional IRAs. The government gets its revenue by taxing us, and in return, we get social benefits. As that relates to your traditional IRA required minimum distributions, that's pretty much like the government saying,
"Hey, we let you save all that money without paying taxes, and now we want our tax revenue. I don't care if you don't want to take the money out. We're going to require that you take at least a minimum distribution."
Death and taxes. If you've been funding a pre-tax retirement account through your employer and you leave that job, you'll likely roll those funds over into a traditional IRA, which is another reason why those accounts are so popular. 401ks and 403bs are employer-sponsored plans. A 401k is for a for-profit organization, and a 403b is for a non-profit organization or government employer. One of the best benefits of these types of employer-sponsored plans is that they are automatically deducted from your paycheck before the money ever hits your checking account. So for you, there's a little bit less emotional attachment to these accounts because it's out of sight, out of mind. The maximum that you can contribute to these accounts is $19,500. Unless you are 50 years old or older, then you could do some catch-up contributions totaling $26,000 per year. That would be in addition to whatever your employer match might be. Not every employer offers a 401k match to whatever you contribute. So as you are weighing different job opportunities and career paths, you need to make sure that you take into consideration what the retirement benefits package looks like throughout your career. Because some companies offer no match, some companies do offer a match, and some companies offer a match plus profit sharing. For example, you could contribute 6% and your employer could contribute 4% for a total of 10%. However, if you contribute, say, 5%, you might not get that full 4% from your employer. So people often say, I'm maxing out my 401k, but sometimes what they really mean is they're maxing out their contributions in order to get the maximum employer match. And there is a difference. However, the sum total between your contribution, your employer's match, plus your employer's profit sharing cannot exceed a total of $57,000 per year or $63,500 per year if you are 50 years old or older. As an example, if you made $195,000 a year and you put away 10% into your 401k, that would be $19,500. If your employer matched 5%, that would be $9,750. So if you add those two together, that would be a grand total of $29,250 per year total going into your 401k. So in theory, if you had the financial means to contribute more than $19,500 into your 401k, it would have to be a post-tax contribution up to the limits I described a moment ago. If you find any value throughout this video, hit that like button. That one simple action by you will help someone else make smart, educated decisions about their finances. What's a vesting schedule? You are always 100% vested in whatever you contribute into the 401k. So really the vesting schedule relates to whatever the employer match or profit sharing is. Every employer will have a different vesting schedule. Some will have no vesting schedule and you'll be 100% vested in whatever their match or profit sharing is from day one of entering the plan. Other employers have a 1 year, 3 year, or 5 year vesting schedule or something in between. 1 or 3 years are, I would say, quite common, meaning you have to stay with that employer for 3 years in order to be 100% vested in the retirement match or profit sharing. We're getting into the weeds here, so stick with me. Take a look at the share classes offered within the mutual funds within your 401k or 403b plan. Hopefully, you have some good performing funds with low operating expense ratios. Examples of share classes that you might see in your employer-sponsored plan would be R shares, R1, R2, R4, R5, F1, F2, I shares, maybe A shares. So take a look because each share class might have a different performance and also might have a different ongoing operating expense ratio fee. Side note, your employer should be reviewing your plan every year. Also, all employer-sponsored plans will have some sort of financial advisor or team or company helping administer the plan. Take a look at your statement and call the number on the statement just in case you have more questions or if you want to learn more about what your options are. There are literally thousands of mutual funds out there that you could select from. However, inside of an employer-sponsored plan, you're limited to only 17 or 20 different options, plus maybe some target date funds. So that will be one of the downsides. For example, my wife's 401k does offer additional options beyond the 17 to 20, but when you look at them, the share class changes, and that sometimes makes them not as appealing. So make sure that you are aware of what your options are and do your own research. Growing in popularity are Roth 401ks and Roth 403bs. These are after-tax contributions very similar to the Roth IRA described earlier. If you make a Roth 401k or Roth 403b contribution, you are still eligible to receive the employer match or the employer profit sharing, but those must go into the pre-tax accounts within your 401k. There is a huge difference though. With Roth IRAs, there are income limitations. Currently right now for Roth 401ks or Roth 403bs, there are no income limitations, and that is a huge difference. 457 plans are commonly referred to as deferred comp accounts. You'll usually find these accounts with police officers or firefighters because these are offered by state and local governments as well as some nonprofit organizations. These operate very similarly to the pre-tax 401k described a moment ago and have the same maximum contribution for 2020 of $19,500. Unlike the 401k, the 457 plan has a really cool feature that allows you to roll over any unused contributions to the following year up to a maximum of $39,000. For example, the annual maximum is $19,500 of deferred comp. If you only defer $12,000, the remaining unused $7,500 can be rolled over to the following year, allowing you to contribute more than $19,500. Pretty cool feature. Thanks for watching. Appreciate your time. If you want to watch part 2 of this video, go ahead and click this right here. If you have any questions for me, leave them in the comments down below. Thanks. Go live your best life.